Hi, I'm Mike Schenk. I'm an economist at the Credit Union National Association, and I joined the Illinois Credit Union League's 82nd Annual Convention to talk to attendees about the macroeconomy, our outlook for the future, how member behavior has changed, consumer behavior has changed generally, and how that's likely to influence credit union operations in the months and years ahead. When we think of macroeconomic activity, we can say emphatically that the economy is in a much better place today than it was a year ago. The economy is growing at a faster rate, and it's at a sustainable rate. Labor markets have improved and improved dramatically. We've added over 2 million jobs over the course of the last year. The unemployment rate has declined to 8.2%, and inflation pressures remain tame in the scheme of things, with the overall inflation rate averaging about a little bit over 2% in the current environment. That means that the Federal Reserve has the wiggle room to continue doing what it has been doing, to keep its foot firmly planted on the economic accelerator, and to keep interest rates low for the foreseeable future, especially in the face of labor market weakness. Labor markets have improved, but they have a long way to go. We are essentially down 5 million jobs since the start of the recession. We lost a total of 9 million overall. We've gained back about 4 million, so we're still about 5 million jobs down. In addition, while I mentioned the 8.2% unemployment rate, we're still very concerned in that that is sort of a tip of the iceberg statistic. We have millions of folks who are underemployed, who are employed part-time, who want to be working full-time, but who cannot find full-time employment. We have roughly 1 million folks that have completely dropped out of the labor force, and because of that, the adjusted unemployment rate is nowhere near 8.2%. When we account for the folks that are underemployed and those that have dropped out, the adjusted, or the U6 unemployment rate, is closer to 14.5%. Many of the jobs that have gone away are gone for good. And we're producing today, in terms of economic output, we're producing today about the same level of goods and services that we were producing prior to the start of the downturn, with 5 million fewer people. That's going to be an issue going forward. How do we get those people back to work? How do we get them to become, again, productive members of society? And until we find a solution for that, consumer confidence will be more than likely at depressed levels from a historical point of view. What does this all mean for credit unions? It means that we're likely to see a continuation of deleveraging in consumer portfolios. We're likely to see relatively low loan growth going forward, and that means more liquidity than we have today. We do expect loans to grow, and that's good news. Investment portfolios will shrink marginally. That will mean bottom line pressures that were obvious during the course of the last several years will become less pronounced. And when all is said and done, we're projecting bottom line results of about 90 basis points ROA in 2012. Capital levels are high. Because earnings will be improving, they should remain at relatively high levels. Asset quality is improving, and generally speaking, we expect credit union operating results to follow the slow but sure improvement that we see in the national